Every time prices rise, you lose a little more freedom. Groceries, rent, gas, they all creep higher, month after month. And if your paycheck doesn't stretch like it used to, you're not imagining it. You're witnessing the quietest transfer of wealth in history, a cycle that repeats every generation. Because inflation doesn't just make things more expensive. It rearranges who owns the future. Welcome to the It's Financial History 2, where money, power, and history collide. And nothing is ever as simple as it looks. For most people, inflation feels like chaos, prices spiraling, savings shrinking, stability slipping away. But for the powerful, inflation is order. It's how the system keeps itself alive. It's how governments fund wars without raising taxes. How corporations erase their debts. And how the wealthy watch their assets multiply while everyone else struggles to keep up. So the real question I answer to why inflation happens, it is why it is allowed to happen again and again. To understand that, we have to go back to when inflation was treated like a national emergency, not an economic target. The gold standard era. In the early 20th century, most major economies were tied to gold. Every paper note represented real metal stored in a vault. Money was scarce and stable. Governments couldn't simply print their way out of problems. If you ran a deficit, you had two choices: raise taxes or face the consequences. Inflation was rare, usually the result of war or collapse, a sign of lost discipline. The idea that a government would choose inflation was unthinkable. Then everything broke. From fear to tool, the Great Depression shattered the illusion of monetary restraint. Prices fell, wages collapsed, banks failed. Money gained value over time, and that killed the economy. Nobody spent. Debt became heavier by the day. It was a deflationary death spiral, and it changed everything. By the end of World War II, inflation had transformed from a threat into a tool. Governments were drowning in debt, some owing more than double their GDP. They couldn't pay it back honestly, so they didn't. They let inflation do the work. Throughout the 1950s and 60s, national debts quietly melted away, not because economies boomed, but because the value of money shrank. The lesson was clear: moderate inflation could solve impossible problems without anyone noticing. The breaking point: 1971. Then came 1971. President Nixon closed the gold window, ending the dollar's link to gold. It was supposed to be temporary. It wasn't. From that moment, money stopped being a measure of value and became a tool of policy. The dollar wasn't backed by gold anymore, only by belief. Inflation wasn't a bug in the system. It was now part of the design. Governments could print endlessly. Banks could expand credit without limits. And investors learned the golden rule: if you hold cash, inflation steals from you. If you hold debt or assets, inflation pays you. Inflation doesn't destroy wealth, it redistributes it upward. The Cantillon effect. The people closest to the source of new money, banks, corporations, governments, get it first, before prices rise. By the time that money reaches you, it's already worth less. This is the Cantillon effect, named after an 18th century economist who noticed it centuries ago. Back then, kings and merchants benefited first. Today it's hedge funds and central banks. Inflation doesn't just change prices, it changes who gets to live above them. The age of controlled inflation by the 1980s. Central banks had perfected the illusion of stability. They targeted 2% annual inflation, just enough to keep the system expanding without drawing attention. 2% sounds harmless, almost scientific. But over a generation, it cuts your purchasing power in half. While ordinary people watch prices double, the wealthy watch their assets double too, and then some. Because inflation is predictable, and the rich plan around it. They own the assets that rise with inflation: real estate, stocks, businesses, while everyone else watches their savings erode. For the rich, inflation isn't theft, it's leverage. For governments, it's relief. Public debt shrinks in real terms year after year. That's why deflation terrifies them. Deflation exposes weakness. Inflation hides it. 2008 and beyond, when the financial system nearly collapsed in 2008, the world got a crash course in modern inflation. Central banks created trillions of dollars to rescue the system, not by handing money to people, but by inflating asset prices. Stocks recovered, housing boomed. Wages didn't. They called it quantitative easing, a technical name for a historic wealth transfer. Those who owned assets thrived. Those who didn't fell behind. Then, in 2020, the pandemic struck, and the cycle repeated. Governments flooded households with cash, supply chains broke, and prices exploded. Inflation hit highs not seen in 40 years, and once again, those with leverage came out on top. The culture of inflation doesn't just change economics, it changes people. It teaches them to spend now, not save. It punishes patience and rewards risk. It turns thrift into fear and speculation into hope. That's how inflation becomes culture. We call it growth, we call it prosperity, but underneath, it has the same system, a cycle of devaluation that rewards those who play the game and punishes those who don't. Inflation isn't a glitch in capitalism. It is capitalism, running full speed uphill with your wallet in its pocket, because in the end, inflation isn't the fire. It's the oxygen. And the world we built can't breathe without it. If this gave you a new way to see money, subscribe. History doesn't repeat, it compounds. And if you know where to look, you'll see exactly who's winning.